Stay with Mira for a moment. Mira is 47 years old. She's been investing since she was 25, every month, without fail. Through the crash of 2020, through the anxiety of 2022, her brain told her to stop. And last Tuesday, she opened her app. The number was $684,217. She sat there for a long time. Not hollow this time, not anxious. Something is different, almost like the finish line had appeared out of nowhere. But here's the part almost nobody explains about money. That feeling, it's a signal, but not the one she thinks. Not because she did something wrong. Most people think the dangerous part is getting rich enough to retire. It's not. The dangerous part starts the moment your portfolio has to start paying you back. My name is Nicholas. You can call me Nick, and I spend a probably unhealthy amount of time thinking about money. Not in a ticker symbol way, more in a what actually changes when the machine turns on kind of way. Because here's what I've noticed. Every piece of financial content out there tells you how to build the machine. Automate, invest, stay in, don't panic. Nobody talks about what happens next. What changes when compounding stops being a promise and starts being a reality. How the strategy that built the machine is not the same strategy that runs it. That's what this video is about. Here's the mental model most people are carrying. Save, invest, grow, retired, spend. Linear, clean, simple. But that's not how it actually works. Because somewhere between grow and retire, there's a phase nobody puts on the diagram, the transition. And the strange part is, most people don't even realize they're already closer to this phase than they think. The moment when your portfolio stops being something you feed and starts being something you manage. Think about dams. For years you're building it, laying concrete, raising walls, directing water in. All the work is about construction, about making it bigger, stronger, and higher. But the day the dam is full, the job changes completely. Now it's not about filling it. It's about controlling the flow, releasing the right amount, making sure the structure holds under pressure. Same asset, completely different relationships. Most people reach $650K, $700K, $750K, and keep doing exactly what they were doing before, still in construction mode, when the dam is already full. So, what actually changes in this phase? 3 things, and all 3 are invisible if you don't know what to look for. First, the math flips. When Mira was at $100,000, a 7% return gave her $7,000. Useful, but she was contributing $6,000 a year herself, so the machine and her were roughly equal partners. But today, she's no longer the laborer in this relationship. She is the CEO. At $684,217, that same 7% gives her roughly $47,900. She's contributing maybe $8,000 a year now. The machine is doing 6 times more work than she is. She's not the engine anymore. She's the supervisor. Second, volatility feels different. When Mira had $50,000, a 20% drop was $10,000. Painful but survivable. At $684,217, a 20% drop is roughly $136,800. The same percentage, completely different emotional experiences. The market didn't get more dangerous. The stakes got higher. Third, the goal quietly shifts. For 22 years, Mira's goal was growth, maximum growth, get the number up. But now, growth is still important, but it shares the room with something new: predictability. Reliability. Income shows whether the market is up or down, and this is usually where the portfolio quietly starts changing shape. Less pure accumulation, more income architecture. This is usually the moment retirees begin layering in income-focused ETFs, not as a way to chase returns, as a way to control the flow from the dam. But this is where retirement math quietly becomes retirement psychology. They think the ETF shift is a financial decision. It's not. It's a psychological one. And if you make it for the wrong reasons, fear, impatience, or the feeling that you've earned something different, you will break the machine right at the moment it's most powerful. There's a specific risk that has destroyed more retirement portfolios than any market crash ever has. It has a name, and almost nobody talks about it. The risk is called the sequence of returns risk, and it's the most dangerous thing Mira has ever heard of. It is the silent thief that steals your retirement before it even begins. It's the reason people with millions on paper still end up broke. Here's how it works. Imagine two farmers. Both have identical orchards, same trees, same soil, same yield potential over 30 years. But Farmer A gets 3 bad harvests in his first 3 years of selling fruit. Farmer B gets those same bad years at the end. Same orchard, same lifetime yield. But Farmer A runs out of money in year 19. Farmer B is fine. Why? Because Farmer A was selling fruit during the bad years to survive. He had fewer trees left to recover. This is exactly what happens to retirees who don't manage their withdrawal sequence. A 30% market drop in year 2 of retirement is not the same as a 30% drop in year 20. Same market, completely different consequences. The timing is everything. Most people hear the sequence of returns risk and think it's a technical problem. It's not. It's a timing problem. And timing problems aren't solved by being smarter. They're solved by having a buffer, so the bad years don't force your hand. And this is precisely why calm, long-term investors, the ones who built the machine right, eventually make one quiet shift. They build an income layer, not to chase yield, to protect the sequence. Something that keeps producing cash flow even when markets get ugly. So, what does this income layer actually look like? The retirees who get this right aren't doing anything complicated. They're not day trading, not chasing dividend yields, not watching tickers. They've built what I'd call a 3-tier structure. Tier 1, buffer. 1 to 2 years of living expenses in cash or short-term bonds. This is the pressure valve. When the market drops, you live here, you don't sell anything. This is the tier that lets you sleep, not because the market is calm, because you know you don't need to touch anything else for 2 years. Tier 2, the income layer. Dividend-focused ETFs, funds that produce consistent cash flow, quarterly, sometimes monthly, usually a mix. Dividend growth funds like SCHD, covered call income funds like JPA. Sometimes REIT exposure, different jobs, different behaviors, same purpose. This refills Tier 1 automatically, and that changes the emotional experience completely. Because now the portfolio feels less like a scoreboard and more like a system. You're not selling shares to live. Income is arriving. The income doesn't need to be dramatic. It needs to be reliable, consistent, predictable, something that shows whether the headlines are good or bad. Tier 3, the growth engine. This is still the machine from episodes 1 and 2. Total market index, long horizons, hibernation mode. You haven't touched this for a decade. Rick Ferri's principle, simplicity, automation, hibernation, was built for the construction phase. In our last conversation, we talked about hibernation to reach the vertical curve. But in this phase, hibernation is what protects the curve. At $684,000, you don't need a better strategy, you need a better temperament. But here's what most people miss. Hibernation matters even more in the income phase, because the temptation to tinker is loudest when the numbers are biggest. At $680,000, every financial product in the world is being marketed at Mira. New funds, new strategies, new optimization opportunities. The retirees who stay wealthy ignore almost all of it. They built a dam, they control the flow, they leave the structure alone. So, here's the reframe. For 22 years, Mira's relationship with money was about discipline. Don't spend it, automate, stay in, ignore the noise. That phase is over. The new relationship is about architecture. How do you design a system that produces income reliably without forcing you to make emotional decisions in bad markets? The answer isn't clever, it's structural. You separate the money by job. One bucket protects the next 2 years. One bucket generates income. One bucket keeps compounding quietly in the background. This is why a surprising number of financially secure retirees stop optimizing maximum growth and start optimizing uninterrupted sleep. When each part knows its job, you stop making fear-based decisions, because fear comes from ambiguity, not knowing which money you're allowed to spend. The 3-tier structure removes that ambiguity entirely. Rick Edelman has argued that we are the first generation likely to live well past 90, possibly past 100. If Mira retires at 65, she may need this machine to run for 35 years, not 15, not 20, 35. That's not a retirement horizon. That's my second life. Your retirement isn't a vacation. It's a 30-year financial marathon, and you simply cannot run a marathon using a sprinter strategy. And the architecture you build at 65 needs to be flexible enough to survive in a world that looks completely different by 85. This isn't a financial challenge, it's a design challenge. So, let's close Mira's story. She opened her app last Tuesday, saw $684,217, felt that strange feeling, part relief, part uncertainty. She didn't know it then, but she was standing at the edge of the transition. Nobody puts on the diagram, where the game doesn't end, it changes. The investors who get this right don't do more, they do different, and most of them don't look rich. They just look calm. They stop building and start architecting. They stop feeding the machine and start living from it, carefully, structurally, without breaking what took 22 years to build. Your 65-year-old self isn't asking you to be brilliant. They're asking you to build something calm enough to last. Because the goal was never maximum excitement, it was a machine quiet enough to survive long enough. Compounding doesn't retire when you do it. It just needs a different kind of care. So, I'm curious, and I read these. Are you still building the machine, or are you finally starting to trust it? Drop it in the comments, because where you are changing everything about what you should be focused on right now. And if this opens something, subscribe. Because the next video is going to go even deeper into what that architecture actually looks like in practice. The specific ETFs, the specific structure, the exact numbers.